Hey traders, this is Ron Hayde at Market Tamer. Happy Monday. Hope you guys had a great day. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and the specific financial issues shall always be addressed by your financial advisor. We'll kick off here with the SPY. We were down closer to 1% today, finishing only lower by a buck, or 0.36%. We closed just 4 cents above the 5-day EMA, so the trend is still bullish. But if we just would think that we closed the lows today, let's just say that happened, we would have gotten right near the 20-day. I'm still going to use that red line, 20-day EMA, as my trailing stop. As long as we stay above it, the outlook is bullish. If we get below it, then it shifts neutral, and then we just go to other moving averages as downside targets. Take a look at the Dow. Ticker symbol DIA. The Dow ETF, it was down actually at one point over 1% today. If I zoom in, you can see we lost about 200 Dow points, or $2.14. We T-boned, if you will, bounced off the 20-day EMA right there around 256. We are below the 5-day, but we're above the red. I'm still going to give the bulls the edge here. Downside targets, if we close below the red, would be the purple 200-day SMA, orange 50-day SMA. Then if we take a look at the Qs, they actually finished in the green by a whopping 3 whole pennies. They dipped down close to the 200-day in purple and the 20-day EMA in red. That's going to add as some confluence support right around 171. So overall, bulls still get the edge. There were a couple questions on my outlook on the overall market. And I am not your typical fundamental person. I believe that the fundamentals are not that good. However, equity prices, like I said in last night's video, if we look at the Qs here, just continue to rise. And it's one of those things where else can you get a return but the stock market? Is it going to end badly one day? I think so. But I think the chance to go tremendously higher is there still. But at some point, there will be a price to be paid for all of the free handouts, and no one asks, where's the money going to come from sort of situation. But what's really important, no matter if you're a bull or a bear, whether we're talking about maybe a stock or something like gold or silver, the gold bugs, or the major indexes. I love to say trade what you see and not what you think, because if you trade what you think is going to happen based on all the fear mongering and stuff out there, or maybe your own opinions, you end up missing. I'm going to go back to it again. Here's tremendous rallies where equities are doubling and tripling over the past decade. Or if I take you back to just a 1-year view, here, take a look at the SPY now. We get down to 235 and it's been 35 or 350, 400 points up. The moves can be incredible here. So we can all have opinions, bullish or bearish, but when we get ourselves in trouble if we're not careful. And what does that mean in terms of trading? Well, let's say I'm a massive bear. I could use a 20-day EMA as a trailing stop and be a bull and maybe only trade with a half-size position or a quarter-size position. I don't have to trade full-on empty the account bullish, nor do I have to be full-on empty the account bearish, because if you've been a bear for the past decade, are you still in the game? It's been a pretty awful thing. And even though, yes, one day it'll roll over, meanwhile, I don't care if the market goes up or down, I can still trade with the trend. So that's how I like to do these videos. Trade what you see, not what you think. All right, a couple things here. We'll look at a couple stocks, then we're going to do protected puts. We'll take a look here at CRM. They were down today almost $6, 3.66%, but after hours, you can see as of about 4:37 p.m. Eastern, they're trading down another 6. So this stock is down about $12 on the day. It's going to put us 153, 153. It's going to put us right around here where my cursor is. We're still above the 50-day. We break the 50-day, we go to the 200. We break the 200, we come back down to this little double bottom down here. How about Polaris? PII. Nice little pop today, up almost 4%, but look what's happening. We just cleared these previous highs around 90. The next target's the 200-day up around 100. That's still 10% potential upside, and I would consider using the 20-day EMA in red as a trailing stop. So we looked at Faceplant yesterday, and I said, hey, watch for this little breakout above the 200-day, below the 20-day. Well, guess what happened? It popped above the 200-day today, closing at the highs of the day, practically up $5 or just over 3%. Immediate targets up there at the previous highs around 170, 171. But then you start going back up here into the mid-upper 180s and then a gap fill. Here too, I would consider using a 20-day EMA as a trailing stop. Now I had a question on protected puts. I just want to give you this quick example on KHC. All right, zoomed in. Here's Kraft Heinz. This stock had a massive gap. This is going to be an extreme example in the sense that the stock lost a ton of its value, but it goes to the point of why protected puts can truly save your bacon, your ketchup, your mayo, whatever you want to call it, in situations like this. The earnings report, according to Thinkorswim here, this little dollar sign, was on 221 at the end of the day. All right. What I like to do is at least go in a day before. Now, we're not going to talk about Vega and implied volatility, and buying a put right before earnings is expensive. I get that. But the point is, without a put, it can get even more expensive when the stock craters, if the stock craters. So let's say I go in the day before the earnings report's due to be announced on the 20th. If I go to analyze, and I set the calendar inside Thinkorswim, think back to 220. Let's just assume we use the end of the day price. If I'm going to buy a long put for earnings, in practice, I like to teach at 60 to 90 days. 120 days is okay too, but generally downdrafts are really fast. So a month is usually plenty of time, but due to time decay, holding an option inside its final 30 days can also result in a lot of lost value due to theta, due to time decay loss. So what's my teaching principle? How about 90 days? Closest thing is May, back on February 20th. Stock is at 48.26. If I go with a near the money or at the money long put at strike 47.50, there's 230 bid, 265 ask. If we're buyers, we're buying at 265. Now, yeah, we might be able to try to get a nickel, dime, whatever off of it. Let's just say we paid 265. The next day, the company is about to do earnings, so it actually lost 10 cents in value. A day after, that put that we paid 265 for is now worth over $1,000 a contract more. It goes from 265 to the bid price of 12.90. Not bad. So the stock lost $13, the long put gained 10. Better than a sharp stick in the eye, right? Well, since then, the stock has gone from $34.95 down to $33.23. If I show you today's price, we type in KHC, and I show you May, that 47.50 today is still worth 14.70. So the stock dropped from, let's say, 48 bucks to 33 bucks, $15 loss. My math is right. We paid 265. There's a $12 gain on the put. You're not losing, you're not gaining dollar for dollar, but that's not the point. Puts aren't designed to do that. They're not completely delta neutral, especially when they're applied at the money. But having a long put into that earnings report allowed for upside potential, but also just protecting the nest egg on a down move. So what I would typically do is buy one long put. Let's go back to the 20th here. One long put for every 100 shares. This is great to practice in a paper trading account. So if I had 100 shares of Kraft Heinz, I would buy one long put, buy to open one long put option in May. If I had 1,000 shares, I would buy 10 long puts. And then what I want to wait to do here is the stock to find a bottom. There is no indication by candlestick analysis or by my own knowledge that this stock is putting in a bottom. The first sign of a bottom that might occur would be if the stock got above the blue line, which is the 5-day EMA, or I could change that to an 8-day EMA. If that happens, I could consider a probability guess and say the bottom might be in, and I could close my long puts. Or I could take those long puts, if I go back to the trade tab at 47.50 that I paid 265 for, and sell to close them, and then simultaneously buy to open puts that are right at the money, maybe strike 32.50. I'd be cashing out a tremendous amount of capital, selling to close at 1,470 bucks a contract and only re-upping for 175 bucks a contract. Or I could buy one in the money and pay 340 bucks a contract. So there are ways to take some capital off the table. By doing so, you reduce the amount of protection, because right now for every dollar the stock drops, in simplicity terms, the delta tells you how much your option will gain. So if Kraft would drop $1, this option is going to gain 88 cents, almost dollar for dollar, not quite. If I move it to a near the money option, it drops to 0.60. Stock drops $1, option gains 60 cents. Stock drops $1, option gains 42 cents. You sort of get the idea. So practice that on paper. I think it's the best way to learn. So I hope you find that helpful. Had some questions on the put, and there you have it. I'll be back with you tomorrow in the next video. Take good care.